$3,250. That is what a $1 million portfolio actually writes you each month in 2026 before a single dollar of tax comes out of it. Not $4,000, not the number your retirement calculator flashed at you last spring, $39,000 a year, $3,250 a month, because the safe starting withdrawal rate for someone retiring this year is 3.9%, not 4%. And if your accounts drifted across $1 million somewhere in the last 18 months, that check already exists. You may have crossed the line without noticing that anything about your life changed, because nothing about it did. Hold that figure, because it is the only number in this entire video that stays still. Everything else is going to move it. Start by giving it a size. The same 3.9% applied to $600,000 pays $1,950 a month. So the distance between those two portfolios, the $400,000 it probably took you a decade of your best earning years to add, converts into $1,300 a month. That is what the threshold bought. Not a different life category, not a different tax planet. $1,300 arriving on the first of every month for as long as the plan holds. A 66% larger check for a 66% larger balance. Perfectly proportional. The check scales with the balance and with nothing else. There is no moment of transformation at $1 million. There is a linear translation of a balance into an income, and it lands on you with all the drama of a utility bill. Now, the harder question, and it is the one the rest of this depends on, $3,250 is the gross. Is that what shows up, or is something already reaching into it before it gets to you? Before that, the rate deserves a defense, because it is doing all the work. 3.9% is not a law of nature, and is not somebody's opinion. It is Morningstar's 2026 base case, the highest starting withdrawal rate that leaves money on the table after a 30-year retirement in 90% of modeled outcomes. For a portfolio holding somewhere between 30 and 50% in stocks and the rest in bonds and cash, 90%, 30 years, conservative mix. Change any one of those three inputs, and the number changes with it. The lineage goes back to a financial planner named William Bengen, who in 1994 sat down with 51 different retirement start years going back to 1926, ran a 50-50 portfolio of large cap stocks and intermediate treasuries through every one of them, and looked for the highest rate that never once failed. The rate that survived all 51 of those starts is where the 4% rule came from, not a forecast about markets, but the worst thing that had already happened, turned into a number and then into folklore. Here's the thing that should bother you about all of it. The American stock market has returned roughly 10% a year nominally since 1926, about 7% after inflation. Your safe check is 3.9. Hold that gap. It explains more than any other fact in this video, and it does not get explained for a while. That rate is also not fixed year to year. 12 months ago, the same base case was 3.7%. It moved to 3.9 on improved capital market assumptions, and the largest single reason is that bonds finally pay something again. The 10-year Treasury was sitting near 4.64% this month, after touching 4.75, its highest level in 20 months. When the boring half of a retirement portfolio yields 4.5 instead of 1.5, the math underneath the withdrawal rate loosens. Convert that into your account and the abstraction disappears. 0.2 of a percentage point on $1 million is $2,000 a year. $167 a month handed to you by the bond market with no decision on your part. That is what a macro headline is actually worth to a retiree. It is not a mood. It is a number on a statement, which cuts both ways, and it should tell you something. If a rate move can add $167, the rate itself is not a ceiling carved in stone. There is a higher number available on the same $1 million. It is quite a lot higher. And the price of reaching it is not paid in risk. Exactly. Which is what makes it interesting. That comes later, once you have seen what happens to the $3,250 first. Quick note before the tax arithmetic. Since it connects directly, I wrote a digital book called The Exit Code, which takes 50 years of retirement data and turns it into a framework for deciding your exit date rather than guessing at it. The withdrawal rate mechanics you're about to watch get taken apart in detail there. The link sits in the description if you want it. So, the first subtraction. If your $1 million sits in pre-tax retirement accounts, the The money you pull is ordinary income the moment it leaves. $39,000 of it against a 2026 standard deduction of $16,100 for a single filer leaves $22,900 exposed. 10% on the first $12,400, 12% on the remainder, and the bill comes to about $2,500, which means $3,040 a month lands, not $3,250. $210 a month gone, roughly 6.5% of the check. And something you have not named yet is deciding whether you keep that $210 or not. It is not the size of your portfolio, and it is not the rate. Watch what one variable does to that same balance. Take the identical $1 million, the identical 3.9%, the identical $39,000 withdrawal, and file it as a married couple. The standard deduction doubles to $32,200. Now, only $6,800 is taxable, all of it in the 10% bracket. And the federal bill is $680, $3,190 a month clears. Same portfolio, same rate, same market. $150 a month of difference produced entirely by a line on a form. The tax bite is not a fixed haircut applied to your withdrawal, which is what most people quietly assume when they run the 4% rule in their head and mentally subtract 20%. It is a function of who is filing and what else is on the return. So if a filing status can move it, what else can? Age can. And this is where the direction reverses. At 65, the code hands you 2 more deductions. The 2026 IRS adjustments set an additional standard amount of $2,050 for a single filer, $1,650 per person if you are married. The same adjustments carry a senior deduction of $6,000 per person, which phases out above $75,000 of modified income for a single filer and $150,000 for a couple. Stack those on the single retiree, and the deduction pile reaches $24,150. $14,850 is taxable. The bill drops to about $1,530, and the monthly check recovers to $3,122. Now stack them on a married couple, where both are 65 or older. $32,200 plus $3,300 plus $12,000. $47,500 of deductions standing in front of a $39,000 withdrawal. They owe 0 federal income tax on it. The gross and the net are the same number. $3,250 leaves the portfolio and $3,250 arrives. If you are new here, the short version of what I do is read the boring documents, the tax adjustments, the withdrawal research, the filings, and translate them into what actually hits your account. By the way, clicking subscribe genuinely helps, so thank you to everyone who does. Because look at what those 4 households just demonstrated. 4 identical portfolios, 4 different monthly outcomes, and the withdrawal rate was never the variable. Not once. The variable was whether the dollar had to appear on a tax return at all, and how much room was standing in front of it when it did. That is the mechanism running underneath everything. Where the money sits decides how visible it is. A dollar leaving a traditional pre-tax account arrives on your return as ordinary income and lifts your adjusted gross income by a full $1. A dollar leaving a Roth account, already taxed on the way in, does not appear on the return at all. Your adjusted gross income does not move. A dollar of gain realized in a regular brokerage account shows up differently again, taxed on the growth rather than the whole withdrawal, and long-term gains sit in their own bracket structure. 3 doors, 1 balance, 3 different footprints on a single sheet of paper. The same $1 million lands on the return in 3 different sizes depending on which door it walks out of. And I would leave it there as an accounting curiosity. Except that adjusted gross income turns out to control something much larger than your own tax bracket. It reaches into a completely different income stream and taxes that too, because you are not living on the portfolio alone. Add the second check. After the 2.8% adjustment that took effect in January, the average retired worker collects $2,071 a month. Stack that on the $3,250, and the combined gross reaches $5,321 a month. $63,852 a year from $1 million balance and an ordinary work record. That is the largest single jump in this entire arithmetic. And it arrives with a string attached that most people discover in April rather than in advance. Your portfolio withdrawal all by itself has already done something to your Social Security before the benefit is even counted. The mechanism is called provisional income. Your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. Run past $25,000 as a single filer and part of your benefit becomes taxable. Run past $34,000 and up to 85% of it is exposed. For a couple, the lines are $32,000 and $44,000. Those four numbers were written into law in 1983 and 1993, and they have never been indexed to inflation, not once. Consumer prices have more than tripled since the first pair was set. When they were written, fewer than one retiree in 10 owed anything. The government's own projections now put it above half, which means the $39,000 withdrawal you take at 3.9% clears the $34,000 line on its own before you add $1 of benefit. You are past the threshold by the act of following the most conservative withdrawal guidance available. That is not a loophole you fell into. It is the design working as written, aging in place for 43 years. So run it. Provisional income comes to about $51,400. The formula caps the exposure at 85% of the benefit. And here it lands at roughly $19,300 of your Social Security becoming taxable income. Add that to the $39,000, and the single retiree under 65 reports $58,300. After the standard deduction, the federal bill comes to about $4,800, which leaves $4,920 a month clearing into the account. That is the headline number of this video. $1 million plus an average Social Security record filed as a single person under 65 nets a little over $4,900 a month. And notice that the tax on the whole stack, $5,321 gross down to $4,920 net, works out to about 7.5%. Substantially less than the 20 or 25% most people assume when they do this in their head. And it is not final because the 65 switch is still waiting. Apply the age amount and the senior deduction to that same combined household, and the taxable income drops to about $34,000. The federal bill falls to roughly $3,850, and the monthly figure comes to almost exactly $5,000. That is the ledger closed. $3,250 gross from the portfolio, $5,321 stacked with the benefit, $5,000 a month clearing after tax at 65. So stop calculating for a second, because the arithmetic has done everything it can do. A different question is standing behind it, and it is the one that actually matters to your life, not what the number is. What the number is worth: $5,000 a month, $60,000 a year, tax paid, indexed for inflation on one of its two legs, arriving whether or not you set an alarm. What does that Tuesday look like? It looks like a middle income month with no commute. If your housing is paid off, the single largest line in the American budget drops to taxes, insurance, and upkeep. And a comfortable rule of thumb puts that somewhere in the range of a fifth of your income, rather than a third or a half. Health coverage before Medicare is the line that hurts. And after 65, premiums and supplements settle into something predictable. Food, utilities, transport, the ordinary machinery of a week, none of it moves. What is left is the part people never picture correctly. It is not lavish. It is a month where the grocery bill is not an event, where a plane ticket does not require a family meeting, and where an unexpected $2,000 repair is annoying instead of structural. That is the actual texture of $1 million. Solvency with slack. And now the $1,300 from the beginning stops being abstract. That is the difference between a month with slack and a month with arithmetic in it. It is a car payment you do not have, or a health plan upgrade, or $8,000 of travel a year permanently. Push it one more notch. Take the couple where both are past 65, both collecting, with the average age couple benefit of $3,208 a month. Their combined gross reaches $6,458. Their $47,500 of deductions absorb nearly all of it. The federal bill comes to under $1,000 for the year, and roughly $6,380 a month clears. Same $1 million portfolio that paid the single filer $3,040. The balance never changed. Everything around it did. And here's the fact that should reframe how modest that month felt a minute ago. $1 million of household net worth sits at roughly the 88th percentile in the United States. Top 12%, the median American household in the Federal Reserve survey holds about $192,000, most of it in a house. So the month you are picturing, the one where repair is annoying rather than structural, is what the top 12% of the country looks like from the inside. Not a yacht, groceries that do not register. The milestone and the month are two entirely different objects. One of them is a percentile. The other one is a Tuesday, which raises a question this whole ledger has quietly avoided. I have spent this entire time calculating what $1 million is capable of paying you. I have not once asked whether anyone actually takes it. They do not. And the size of the gap is the most surprising number here. Blanchett and Finke, publishing in the Financial Planning Review last year, went into the health and retirement study, the long-running nationally representative panel that follows Americans over 50 through actual retirement and measured what people withdraw rather than what models say they should. Married 65-year-old households with meaningful retirement assets pull about 2.1% a year. Single retirees, about 1.9%. On $1 million, 2.1% is $21,000 a year, $1,750 a month. That is a bit more than half of the $3,250 this video opened with, and roughly a third of the $5,000 that clears once Social Security is stacked. The safest withdrawal guidance in the industry is not the constraint on the American retiree. It is not even close to being the constraint. The reason is in the same study, and it is not about arithmetic. Retirees consume roughly 80% of their lifetime income, Social Security, a pension, anything that arrives as a recurring check. They consume only about half of their other savings. Same dollar, same purchasing power, same person. The dollar that shows up as income gets spent. The dollar that has to be extracted from a balance gets defended, because a withdrawal registers in your head as a loss. You watch a number you spent 30 years growing go down, and every instinct you built during those 30 years fires at once. A deposit registers as permission. Nobody experiences their Social Security check as a drawdown, even though it is one. You are consuming a lifetime asset every month, and it feels like getting paid. That is the psychology of money problem, sitting under the whole subject, and it costs more than any fee ever will, which makes the real risk at $1 million the opposite of the one you have been trained to fear. Running out is not the documented common outcome. Dying with more than you retired with is 30 years of 2.1% withdrawals against a portfolio compounding through them means the balance grows for most of retirement. You spend your 60s economizing to fund a bequest you never consciously decided to leave. And this is where I want to be precise, because it is not villainy. An advisor paid 1% of assets under management collects $10,000 a year on your million. If you spend down to $700,000 living the life the money was for, that fee becomes $7,000. Nobody in that chain is lying to you, and most of them are working under a genuine fiduciary obligation. But there is nobody in the entire structure whose income rises when you spend. And the retirement calculators are built by firms with the same shape of incentive. An honest system with only one direction of pressure eventually looks a lot like advice. Here is the part a retirement calculator structurally cannot give you. Knowing the number and building a system you will actually let yourself spend from are two different problems. And the second one is where almost everybody stalls. That gap is why I built the Exit Code, 8 chapters of research, no filler, drawn from 50 years of actual retirement data rather than opinion. 2 pieces of it connect straight to what you have watched here. The 4% trap, which takes apart why a rule engineered for one specific 30-year worst case became the default answer for retirements it was never tested on, and the dynamic withdrawal method that replaces it, flexing with what the market actually did instead of pretending every year is average. There's also the Social Security bridge. For anyone weighing whether waiting until 70 is affordable on a portfolio this size. It costs less than 1 hour with a mediocre financial advisor through the link in the description. Every year, spent planning around the wrong framework compounds against you, and that is arithmetic rather than salesmanship. Which brings back the gap I left open near the start. The market returns about 7% real. The safe check is 3.9. Where does the rest go? It does not go anywhere. It was never available. 7% is an average of a series that has almost never actually delivered 7% in any given year. It delivers 22, then minus 18, then 11, then minus 37. You cannot withdraw an average. You withdraw from whatever the balance happens to be on the day you need the money. And averages are a description of the past, not a schedule for the future. The distance between 7% and 3.9% is the price of a check that does not vary. Every point of that gap is buying certainty about the amount in a system that cannot offer certainty about the returns. Benjamin's data showed exactly where that price gets paid, and it comes down to one specific retiree. Someone who left work in October of 1968 at a market peak walked directly into two savage bear markets and a decade of inflation that ran into double digits. They sold shares at depressed prices to fund an income that inflation kept ratcheting upward, and those shares were not there when the recovery finally came. That one start date out of 51 is what dragged the safe rate down to 4.15%, not the average outcome, the worst one. Your entire withdrawal rate is priced off a single unlucky October, because the person retiring in 2026 has no way of knowing whether they are that person until it is far too late to change anything. So the 3.9% was never a limit on what your money can do. It is the cost of demanding a fixed number every month for 30 years. Loosen that one requirement and the ceiling moves dramatically. The same Morningstar research finds that a retiree who adjusts spending in response to what the market actually does, taking less after a bad year, more after a good run, can start as high as 5.7%. On $1 million, that is $57,000 a year, $4,750 a month from the portfolio alone before Social Security. 46% more than the base case out of the identical balance. That is not a product, and it is not a trick. It is a trade, priced honestly. The fixed check buys you a number you can put in a spreadsheet and never look at again. The variable check buys you $1,500 a month more, most years, in exchange for accepting that some years it comes down. What that actually looks like is the same Tuesday, with a different relationship to the calendar. In good years, the travel budget is real, and the house projects happen. In the year after a 30% drawdown, the check steps down, the trip becomes domestic, and the kitchen waits. Nothing collapses. You do not sell shares at the bottom to fund a number you promised yourself in 2026. And that is the harder change, because it asks something of you that the last 30 years actively trained out of you. The person who accumulated $1 million won by being rigid, automatic contributions, fixed savings rate, never flinching, never adjusting. Every one of those reflexes was correct, and every one of them is now the expensive habit. The distributor's job is the opposite. Read the conditions, spend into strength, pull back into weakness. Staying in the accumulator's role at this balance is what produces the $1,750 month on a portfolio built to pay $5,000. The chain is short enough to hold in your head. The withdrawal rate sets the gross check. Where the money sits decides how much of that check appears on your return, which decides how much of your Social Security gets dragged into taxation, which decides whether $5,000 a month clears or something meaningfully less does. And only when that number is genuinely reliable will you spend it like income rather than defending it like a balance. Lazy investing built more fortune than crypto memes. And this is the part where lazy stops meaning passive and starts meaning deliberate. So here is the whole ledger in one pass, a few numbers at a time. Start with the gross, $3,250 a month straight out of the portfolio. Then the tax. And where you file decides how much of it survives. About 3,040 clears for a single filer under 65. 3,190 married. The full 3,250 for a couple past 65 who owe nothing at all. Then Social Security lands on top. 5,321 gross, about 4,920 clearing, 5,000 once the age deductions apply. And then the last two, which are the ones you choose, 1,750 a month, which is what the average millionaire retiree actually takes. 4,750, which is what the same portfolio pays the retiree who accepts a check that moves. That is what shows up each month once your portfolio crosses $1 million. The largest number on that list is not the one the market hands you. It is the one you decide to take. Subscribe if you want the version of this where we run the same ledger against the account location question, because that one is worth more than the withdrawal rate.